Okay, guys, so welcome to our fourth episode. We are very excited to have a very special guest. We have our good old friend Vessi on the podcast here. So just to kind of give you guys a little background on Vessi. So Vessi has 18 years of business experience that includes 14 years of commercial lending and 4 years of business management, sales, and marketing. Vessi started her real estate journey in 2017. Today, Vessi controls a portfolio of investor real estate properties in Florida, Tennessee, Georgia, about 161 doors, 6 properties. Her lending experience has served her well in developing a conservative and analytical approach in assessing risk and investing prudently in real estate in order to maximize returns. Her business experience has helped her develop a solutions-oriented, execution-focused approach, which has served well in asset managing her real estate portfolio. Vessi is active in various real estate professional networks and a frequent speaker at meetups or podcasts, as she's doing today. And Vessi's mission is to help others attain their own financial freedom while at the same time providing a clean, safe, and pleasant home environment for her clients, aka tenants, and improving the local communities she invests in. Vessi has earned a bachelor's degree in business from University of Arkansas. We were just chatting about that a little earlier, and a MBA from Northwestern University. So very impressive background, and welcome to the show today, Vessi.
Thank you so much, Jefferson and Jon, for having me on as a guest. Really look forward to our conversation today, adding value to the listeners.
Perfect, awesome. No, we're excited to have you on. And Vessi, if you want to just kind of get started, give us a little background on yourself, maybe add some some points to what I just mentioned there. I know I kind of went broad there, so if you want to just let the listeners know a little bit about yourself, how you got started in real estate, and maybe just some details on your first deal, and then we'll kind of get the ball rolling there.
Yes, happy to share. Yes, the first deal is always a fun one to talk about, but really what pushed me to take action and get that done was a couple of things. One was a desire to diversify away from the stock market, especially after I saw some of the volatility following events like the Enron scandal that left people pretty much without any 401ks or other retirement options. Of course, the 08-09 crash. And then along the way, my own employer went through a couple of restructures, and I survived, but I didn't think I was any better or more talented than my peers. If anything, I was just lucky, and that I thought at that point of time, wow, that could have been me. So all of that combined over a period of years really caused me to take a step back and think through, well, I don't control the economy, I don't control how what actions my employer takes or how they restructure, but what I can control is my own little world and retirement portfolio. That then caused me to start looking at various options, primarily in the residential space. That's something that most people are familiar with. And growing up in Bulgaria, investing in hard assets such as real estate was something that really came more naturally. We didn't have a developed stock market. So when I thought about how do I grow my retirement portfolio, I thought about real estate and how do I diversify it further to avoid that volatility from the stock market. Real estate emerged as the natural contender. At that time, and I still do live in California, so for me to buy a home here was not only pricey, but my goal was cash flow. I wanted a cash flowing asset, which is not impossible to achieve, but it requires a pretty substantial down payment here. And when you layer that on top of the already high price points, that really limits the start or for a lot of people due to the high amount of liquidity required. So between that and the desire to look at more business-friendly jurisdictions led me to look out of state. It was a very, I describe it as a very nerve-wracking experience because I was always taught that you buy a home within a mile or two of where you live, or at least within a short driving distance. So to have property elsewhere was a very new concept for me, but considering the circumstances I just shared, that was really where I had to look if I wanted to take that first step, and I wanted to take that first step for the reasons I shared. So I started attending various meetups, really as a way to educate myself on how to invest out of state. And there was a particular speaker who was very active, very frequently presenting, talking about investing, talking about investing out of state as well. And he would always say, if you have any questions, call me. And so one day I called him. I asked, hey, do you know anyone who sells properties out of state? And sure enough, he did. We looked through various options, and I made a decision, and the rest is history. So that's how I really got started, and we can talk about how I got to where I am today. But I'll pause, and happy to address any follow-ups or dive deeper.
Well, no, that's really interesting, because that's a lot of our fear, some of our listeners' fears, right? Because we preach and we teach people how to invest, especially Canadians, how to invest in the U.S. So in many cases, that it's outside of their backyard, outside of their country, for instance. So there's a lot of fear. Would you say, what would be the biggest kind of fear that you had when you were thinking about out of state? Was it like a mindset thing, like limiting belief, like, oh, I need to go to the property, or what were some of those like thoughts or thoughts when you're thinking about investing out of state?
Yeah, it was really the fear of not being able to oversee or really oversee the property, fear of lack of control. But then as I took a step back in thinking through the process, I knew I didn't want to self-manage. And I realized, well, even if the property is here in California, let's just say it's somewhere in Bakersfield, which is an hour or two away, will I really be driving there every week or an hour or two to go solve problems? Probably not. More likely than not, I would be hiring a third-party property manager who either has their own maintenance staff, preferably one who has their own maintenance staff, or I'll have to be contracting, right? Maintenance folks and other personnel to take care of the day-to-day management. So if I will have to do that here anyway, what's preventing me from doing that elsewhere? So from there on, really focused on, well, first of all, making sure it's the right market, because you can do a lot of things to a property, and especially as an out-of-state investor, you really need to ensure that you're comfortable with the area. And if you're not familiar with the area, make sure you talk to someone who you trust, who will give you that direct feedback about the area. And then step two is your team, your property manager, your realtor, if you're rehabbing, of course, the contractor, and doing that initial vetting there, so you can have the team to help you effectively monetize that investment out of state, and remove any concerns around you not being there all the time. Absolutely.
No, you touched on some great points. I wrote some notes here. Now,
amazing.
For yourself, where were you able to find the team? I'm sure there's a common question most people may have, like, where did you find the team to be able to accomplish this?
Yeah, so that speaker already had contacts in the area, and that's where those conversations started. So he actually already had a property management firm, so I decided ultimately to work with them, and they had their own maintenance staff. I did actually, so that particular property is in Memphis. I did fly to Memphis just to, I had done preliminary research on the neighborhood, because especially like most big cities, right, Memphis can be very pockety. So you need to make sure you're in the right part of town. And I had done preliminary research to firm that up, but I still went there for that very first purchase to drive around, tour the neighborhood, meet the team, go to their office, meet their staff, just to establish that initial level of comfort, better understand how they operate, how they think, how they manage. We actually toured a couple of properties that they had in the market that were available for rent at the time. So we were able to kind of walk through and see the type of work they had done on the interior and so forth. So that's really what got me comfortable, and it was by asking for referrals, asking for people who had good experience. And in that case, it was probably a very straightforward connection because that speaker already had presence in the market. So that accelerated the process for me. But I would say probably asking for referrals and then going on site, at least for that very first purchase, to make sure you are getting what you're promised.
Absolutely. That is very important. Referrals and network in real estate is absolutely crucial. Vessi, I wanted to touch base on some underwriting here. How is your underwriting and just learning process, and how are you underwriting in today's environment as well?
That's an excellent question because it's always evolving. There are certain fundamental principles that you follow, but what I love about underwriting is the fact that it evolves with the market, it evolves with the property, and actually evolves throughout the diligence process. I know I briefly talked about my very first purchase, which is in the residential space. I have since transitioned to, or expanded rather, to the multifamily space, and the underwriting there is quite different. Because in the residential space, right, the lenders typically look at your individual, your personal income, and that's how they make a lending decision, and
Correct.
not only on whether to lend, but how much to lend. When you transition to the commercial space, you're effectively running a business. Each property is its own mini business. And so what lenders are looking for is the cash flow, and is that business generating sufficient cash flow to service the debt. So there are a few important areas that I always look at when I do my initial preliminary underwrite. We talked about the market already. I would dial in a step further and say the sub-market, specifically when it relates to median household income, the crime rates, poverty rates, because if you think about it, these are all factors that ultimately impact not only the revenue side of your equation, but also the expense side. And so speaking of revenue and expenses, of course, taking a look at the current trends versus the market trends, is there sufficient gap that you can close, or loss to lease as it's known in the market? Making sure the rent growth projections are reasonable. So that's one adjustment I've made. On prior interviews, I would have said rent growth assumptions consistent with historical growth rates, but based on the most recent rent trends that we're seeing, and again, that's very market to market specific, but it's not uncommon to, in the current environment, to project no rent growth in the first year. Frankly, in some markets, you're probably seeing rent declines. So making that adjustment, and of course vacancy assumptions, making sure those are closer to the historical average, especially as we are entering a recession. Well, I would argue we're probably already in a recession, but let's just say we're entering a recession, right? Especially in the Class C property space, there will probably be a little bit more distress there. And so making sure those assumptions are realistic and not just plopping in 5% physical and 3% economic vacancy numbers. On the expense side, and actually Jefferson and I chatted briefly about it before we kicked off the podcast. In certain markets, we've seen a tremendous growth in the tax reassessment, so tax expenses, and then insurance. So Florida, which is one of the markets I've focused on acquisitions, it's not uncommon to see those premiums triple. When I first started underwriting a couple years ago, $500 a door was a pretty common number, and to here in Florida eventually evolved to $800-900. Now you're looking at $1,500 if you're lucky. It's not uncommon to see premiums go as high as $3,000 a door, especially if you're right at the coastal areas and so forth. So just making sure you adjust for these numbers, because more likely than not, those will change after the sale. And really understanding your market, which goes back to my original point, because in some counties, right, the tax reassessment doesn't automatically happen at sale or annually. Sometimes taxes are reassessed every 3 to 5 years. So you want to understand that, because if on the flip side, if you are projecting immediate reassessment, then you may be leaving some money on the table and maybe even losing on deals, right? And then I would say interest rate. We all know that, but not just interest rate. I would say overall the debt terms, making sure that those are in line with your business plan and you're building in sufficient cushion. We're still in an environment where rates are rising, so you don't want to be retrading in the middle of the deal or towards the end. So leaving in some cushion there as well. And cap rates, because of the rapidly rising interest rates, cap rates have been reversing, and I wouldn't be surprised if they continue to reverse. So making sure your entry and exit cap rate assumptions are realistic. And last but not least, reserves. I like to budget for additional reserves, at least 6 months of operating expenses and debt service. I know some people may deem this excessive, but the deals I'm currently on are doing okay, but I can sleep well at night because we have those additional reserves. So if we do get surprised with an unexpected insurance increase that wasn't in our original budget, or a tax bill or something else, we have that cushion to tap into versus asking investors for capital. So those are some adjustments I've made over the course of the last few months as the markets have been evolving.
Wow, it's amazing just listening and learning. You talking about underwriting, that was great. How is the Florida market, and how are you seeing the numbers when you're underwriting properties? Are you looking more for long-term appreciation, or is it more of a cash flow perspective?
I'm definitely focusing on cash flow, and that's my number one investment criterion. And a lot of investors are also looking for that in terms of creating that additional income stream. So that's a very important factor. With that said, it's been more and more challenging to find those cash flowing deals in Florida, specifically for the reasons I just stated. Well, first of all, deal flow has slowed down 50 to 60% less than last year. So the deal flow is smaller than last year. But then on top of that, the deals that are coming on the market are either deals that are kind of being recycled, or maybe deals that closed a year or two ago and now sellers are suddenly looking to exit, either due to looming bridge loan maturities or possibly because they didn't have enough cushion or reserves and are now unfortunately having to deal with all these unexpected increases on insurance, tax reassessments, and so forth. There's still a disconnect between buyers and sellers, but I'm hearing that across the entire market space and landscape, not just for Florida. So it's really, unless you're someone who's looking for long-term appreciation, not so cash flow sensitive, then I think you'll do well in that market. It has done amazingly in terms of appreciation over the last few years, and a lot of people are continuing to move to Florida for a number of reasons. A lot of businesses are setting up shop there or expanding their footprint, which will then drive more population, continuous income growth, and so forth. So I think the long-term prospects for Florida are great, which is why I'm continuing to look there. But it's become very challenging to find deals that pencil in for the reasons I just stated. And I also need to be cognizant, right, of my investor requirements. A lot of them are looking for 15 to 20% IRR, 7 to 10% cash on cash, 1.5 to 2 times equity multiple. And especially right now, they have great options when you can buy a treasury at 5%, right? They're weighing in those alternatives. So I really need to be cognizant of that as well, and make sure I hit those at least the minimum required return to make this a worthwhile investment opportunity, not only for me, but for them also.
Absolutely. Looking after your investors and making sure that you're hitting your numbers is absolutely crucial. Tax assessments in Florida, insurance, it's crazy. Can you talk a little bit about managing your portfolio while working a full-time W-2, and what was it like, and how did you manage going through that?
Mm-hmm. Yeah, I'm still doing that, but I want to be clear that I'm not doing this by myself in a little office here. I have a team that I work with for the properties that we own. One is a joint venture, the other one is a syndication, and each team member has their own assigned responsibilities. I do have partners who are in these markets, which then eliminates, or I should say reduces, right, the need for me to be there all the time. I don't need to be there. And we're also working with third-party property managers or asset managers who are really more hands-on and are taking care of the tenant calls, the maintenance requests, basically the day-to-day operations. So when you take a step back, I'm really more involved in a strategic advisory capacity role, of course, looking at the numbers, helping with the financial reporting and analysis and so forth. And so that's how I've been able to manage the process, because again, I'm relying on my team. We're all helping each other to execute on the business plan and move forward.
And that tracks back to the importance of having a team. So no, great, that's amazing.
Yes. Yeah.
No, that's great. Now, one thing I wanted to ask, and I know we talked about it before, like maybe the first time we chatted, was the difference between like joint ventures and syndications. Mm-hmm. I wanted to ask you, what do you prefer in this environment with high interest rates, like you were saying, reverse cap rates and everything else that's going on? Do you believe that these smaller multifamily joint venture deals are a better route than the larger syndications right now? Do you think it depends on the market? What are your thoughts on that?
I mean, I would say as usual, the answer is it depends. I personally like both joint ventures and syndications, and I can speak to what I like about each one and why I plan to continue to look into both. For joint ventures in particular, those tend to be smaller deals that have lower capital requirement, and by virtue of that, there are less management team members involved. Usually, I would say maybe anywhere from 4 to 6 people, depending on the size of the deal. The beauty of the joint ventures is that you have these 4 to 6 people, everyone has a job, so everyone needs to be actively engaged in the deal. But you do have a little bit more flexibility in terms of the business plan, when to exit, or you could potentially hold this asset forever and just keep refinancing, and you don't have that pressure to sell every 5 years or so. Of course, by virtue of that, the joint ventures also have a higher capital requirement. So if you have continuous liquidity coming your way, that of course enables you to continue to do joint ventures potentially forever. But for a lot of people, that's not the case, and that's where syndications come in, that don't have that higher capital requirement, but also allow you to bring passive investors who may not necessarily want to have a job or be actively involved in the deal, but still want to take advantage of all the various benefits that real estate offers. And for me, it's also very personal, because I wish I had known about real estate sooner. I wish I had taken action sooner. And frankly, if I had known about syndication sooner, that's how I would have started, but I didn't. And I really want to spread that message and make sure that people are aware that it's not just the stock market that you can invest in. And real estate can be a very powerful tool for building that additional income stream and potentially finding your own financial freedom if for whatever reason you want to transition out of your W-2 and pursue whatever freedom means to you. So the ability to bring passive investors and help them with that mission is something that's very rewarding to me, which is why I will likely continue to pursue that model. So I like the long-termism, if you will. I think that's a term Jake and Gino carved out associated with JVs, right? You don't have to effectively flip or sell them every 5 years. But I also want to help other people discover the power of real estate, and I think syndications is a wonderful tool to do that.
Love that. No, love that. And I totally agree with you. I know that one of our a folk that we spoke with not too long ago, he mentioned to us that you make the money through syndication and then you buy your multifamily with that, like your own personal portfolio with the proceeds from that, 1031 into your own deals, into use that money to build like a business and generate money, and then deploy that into your own personal portfolio, which I thought was interesting, right? Because then you're kind of building the wealth, but you're also having that active income, so you're building both. So no, that's a really good point.
Vessi, what would you say as you progress and as a general partner, as a real estate investor, what would you say your strengths are, and what is your power in the team? What do you mostly focus on and bring to the table?
I would say my power is, well, twofold. One is I enjoy building relationships, whether that's on the active side with partners and potential partners, but also my investors as well. So that would be number one, which would be bringing capital. And number two, not in any particular order, is really the underwriting and the numbers. I come from a commercial lender background of 15 years or so, and while today I don't focus on real estate, at one point of time when I was within the domestic division of my firm, a big chunk of my portfolio was real estate, where I focus on more traditional bank type of lending versus the agency world. But it gave me a really good perspective on what to look for and how to evaluate deals from a lender's perspective. And I enjoy digging into spreadsheets. I can't say I'm an Excel guru or anything like that, but I enjoy that part of the process and really unveiling the story that the numbers tell.
Well, that's really interesting, because kind of like what you mentioned, you have your skills allow you to do so many different aspects of the business, both from asset management, because you have that experience with your own properties and with your own portfolio, but like you said, you have that background of an underwriter, so you actually understand how the numbers work, how the numbers can pencil out. But then something interesting that you mentioned is that you're very passionate about bringing on passive investors and helping them create wealth, right? Because I feel like even till today, even though real estate has become so popular, there's still a majority of the population that don't know this is a vehicle. They don't know this can be possible, and that's kind of part of the reason for this podcast here, was just to share them and spread that message to as many people as possible, and let them know that, like I said, there's other options than the stocks, the mutual funds, all the other vehicles, right? There's this vehicle called real estate, not only like your single family, but apartment buildings, multifamily. That's a really good point. Okay, and then the other thing I wanted to ask you is, what are the markets that I know you mentioned Florida. What are the markets that you're currently have your eyes on, and is there any specific markets that you are new to your radar that for the listeners to know, or just to kind of get to know a little bit about you and your investment criteria?
Yes, I'm happy to share that. At this stage, I'm choosing to be more focused versus spreading myself everywhere. I'm so really focusing on states where I already have presence, either with my existing multifamily portfolio or on the residential side, which is an income stream or vertical I'm still planning to maintain. I'm not necessarily looking to dispose of those homes necessarily. So that includes the states of Tennessee and Georgia. With that said, ultimately, when I look for deals, I look for strong operators, strong markets, and of course, last but not least, making sure the deal also makes sense. So I'm definitely open to other places in the Sun Belt, but ultimately I'll have to do my preliminary research before I jump into a deal there, to make sure the fundamentals are still consistent in terms of population growth, job growth, income growth, and job diversity, and then of course evaluating the submarket accordingly. So like the Carolinas come to mind. Of course, Texas, there are a lot of submarkets within Texas as well. I know a lot of people are talking about the Midwest. I haven't really looked into that very closely, but I know there are some very strong sub-markets there as well. So these are just to name a few, but for me personally, for now, I'm staying focused on Florida, Tennessee, and Georgia.
Nice. And then within Tennessee, I know we chatted briefly. We like Nashville into Tennessee. Also, we've looked into Knoxville and Chattanooga. So those are some places that we've looked at some real estate and we see the opportunity. Now, last I've heard, and I don't know if you've seen this, but I've read somewhere that Nashville rents are actually in declining right now. Now it's, well, you know, what are some of your thoughts on because I know we talked about some of those markets not really, you know, the rents declining as they've been going up and up and up and up, right? So what are your thoughts on that when it comes to underwriting? I know one of the things you mentioned is that you don't project any rental growth for a year. What are some other practices or things that folks can do to help prepare for that?
Yeah, definitely. One metric I look at, especially in the current environment, is absorption. And in a lot of markets, particularly ones that have a huge supply of multifamily apartments coming up. So Nashville is one of them. I think Jacksonville is actually another one, so I'm watching very closely, is taking a look at that absorption rate. Because naturally, if you have more supply coming on the market in an environment where there is less of a demand, that leads to negative absorption, which effectively means less demand, right, for units and apartments. I'm also very closely looking at median household income and how that is trending, and where market rents are relative to median household income, because that's also another indicator of really a cap of how high rents would go. And especially in a slower economic environment, and again, I'm very careful to use the word recession here because I don't want to change the discussion necessarily, but in that type of environment, or especially if people are losing jobs, it's not uncommon for them either to move back home with mom and dad or group with roommates. So which then again results in lower demand and potentially further pressure on rents. And last but not least is really the unit mix, because in that type of environment, especially if people will be roommating with one another or potentially with more folks, the 2-bedroom units tend to do better versus the studios or the 1-bedroom units. So that gives you a little bit more flexibility. But that is not necessarily a reason not to invest in these markets. It just means that you need to do your research, make sure you feel good about the numbers, and then value the asset accordingly. And if the price makes sense, definitely move forward, especially if your plan is to hold that asset for a long time. If you're looking to flip, then that's a different story, and the timing is a little more important in that scenario. But if the numbers make sense, I wouldn't be necessarily discouraged from continuing to invest. And I really look at this as a time of opportunity for us to expand our portfolios at hopefully more sensible valuations and pricing.
Well, Vessi, that was great. I wanted to shift a little bit from market analysis and get your thoughts on what you're seeing in the lending environment. Are you seeing a more higher loan value? Are you seeing a debt service ratio increase, decrease? What are your thoughts on the lending environment right now?
Yeah, all of the above that you listed. If you think about it, the actual fundamentals of underwriting for the lenders haven't changed, right? They're looking at, and we talked very briefly at the beginning, they're looking at cash flow, and is that asset generating sufficient cash flow to service the debt? And typically the minimum debt service coverage most lenders look at is a 1:25 ratio. So that hasn't changed, but what has changed in the markets are all the things we talked about as far as higher valuations and potentially overpriced assets, softer rents, higher expenses, all of which is leading to cash flow compression. So when they're sizing up that loan based on cash flow, that inevitably results in lower loan-to-value ratios, which is why we saw a big drop from the 75, in some cases 80% ratios, to now more of a 50 to 60% environment. The other thing too, and again, that's lender specific, but it's your hedging strategy on the interest rate and how you're mitigating that interest rate risk. I think before there was a little bit more flexibility, especially if you're getting in with a variable rate loan. Now I think most investors are looking into fixed rates, but if you are looking into floating, then most lenders are requiring you to hedge that in some form or shape, whether it's through interest rate caps or interest rate swaps, and there are different strategies that one can evaluate there. So from that perspective, I think the fundamentals haven't changed, but the result of all the changes in the market that we just talked about are resulting in lower loan to values and higher interest rates just by virtue of where the market is. And then you have to keep in perspective, right, the overall lending landscape with all the things we saw in the news earlier this year and the various banks collapsing. In my own humble view, and again, this is just my personal view and no one else's, I do think this will lead to more increased regulatory oversight, specifically in the mid-tier lending segment, which naturally results in one or two things or both. It increases the cost of compliance for a lot of these lenders, increases their capital requirements, which naturally would lead to increase in their cost of doing business. So we'll see higher rates overall, probably less of the looser standards that one could find with some of those smaller local or regional banks. So definitely the underwriting will be a little bit more consistent. And specifically for smaller or mid-tier lenders that have perhaps higher concentration in certain industries, real estate being one of them, that may also lead to lower overall risk appetite for lending in that space. And we're already seeing not only banks collapsing, but certain lenders exiting certain markets and in the multifamily space in particular. So all of that will ultimately boil down to less, I guess, credit appetite and more credit tightening.
Wow. I'm just mind blown because I'm sure the viewers are going to get a ton of value just from what you've been able to share. Like as I mentioned, a lot of our listeners are from Canada, and you know, we've been trying to help folks and teach folks that, you know, underwriting deals, looking at the markets in the US is a whole different beast. And you know, you're underwriting a deal here, you're looking at a 10-20 unit building. In Canada or here, for the most part, the major thing is, can you reposition that asset in terms of getting tenants out because of the landlord rules that we have here, and then you can get the rents. You know, the rents here, you know, average 600, let's say, but you can get 1600, and there's a lot of demand here, but then the economics don't make sense in terms of you know, wages are not going up, but yet rents are still going up. So it's unusual. So you know, we were really happy to bring you on and share your thoughts. But not only that, but I wanted to circle back to a little bit. So you originally are from Bulgaria, right?
Yes.
Okay. Now, how, you know, for anybody who may be, you know, an immigrant, like we're immigrants ourselves coming to Canada, you know, coming from Bulgaria to the US, was your purpose always to be in the US, like as a student, and then a transition, and then from that to now owning, you know, hundreds of doors, you know, buying assets? I mean, how you know, it's very inspiring to say the least, right? And for anybody who's listening, who's maybe an immigrant, they don't know, or they have, you know, they're you know, nervous about starting out, or they don't believe in themselves. You know, what are some things that helped you get by when starting and when going through this process?
Yeah, so I guess to answer the first question, actually my intent was always to go back and make my country a better place. But after I arrived here, one opportunity led to another. And before I knew it, this was really home. And this is meaning the US was home, and where I really chose to continue not only my education, but also my professional development. And now I'm a citizen of this country and proud to be a citizen. So my initial plans changed over the course of the years, and my family is here now. As far as the mindset and the limiting beliefs, I started with a home, and I didn't really have a vision of I want to own hundreds or even thousands of doors. It was really the desire to build that retirement nest egg, but that's where also the light bulb went on when it worked, and it caused me to buy another property and then another and another. And before I knew it, I realized, wow, this is not just a small retirement nest egg. It can be something bigger that not only could help me, but potentially could help others. And it's the desire to grow that continues to push me. But ultimately, what I share with people is be very clear on what your goals are and why you want them, because it's really your why that will help you overcome some of those initial fears or that hesitation. It will push you when times are not going well, and it will propel you further when things are going great. So knowing your why and what really drives you, and why do you want to do this, right? Because if it's money, that will get you only so far, but knowing your purpose is what really has helped me overcome some of the challenging moments along the way, and there are many of those, as well as continuing to inspire me to grow the portfolio.
I love that. And one of my favorite things about that is that you're coming from a place to serve. Like, you're trying to serve other people. You're trying to serve your investors. You're trying to serve your partners, right? To serve. So as long as you come from a place to serve, I feel like you're always going to be in the right path, and life's going to go your way. So that's incredible. I love the mindset behind it. Go ahead, Jon.
Vessi, we wanted to know, what are your 5 to 10 year goals that motivates you, and what are they?
Yes, so within the next 5 years, I would like to be job optional. Like I mentioned, I still have my W-2 job, but I enjoy building that portfolio on the side. I enjoy building others, and I would love to be able to do this full time eventually. So that's within the next, hopefully, 5 years. And then within the next 10 years, being able to scale the portfolio and help at least 100 people find their own freedom, whatever freedom means to them over that 10-year period, and hopefully, whether that's exiting the rat race or taking care of a loved one or traveling around the world, whatever that is, would love to be able to help others over that longer term horizon.
I love that, and I have no doubt in my mind that you are going to accomplish that, and I can't wait to be to see your journey and hopefully be part of the journey. So no, that's awesome, Vessi. Hey, and Vessi, I know we're pretty much wrapping up here, but as we're wrapping up, Vessi, we just want to thank you for being on the show today and bringing so much value to the table. Where can listeners who want to reach out to you, learn a little bit more about your company, passive investors, where can they reach out to you? I'm sure we'll have your social medias on the show links, but what's the best way to get in contact with you?
The easiest way is through my website, www.dbacapitalgroup.com. D is in dream, B is in believe, A is in achieve. My contact information is there, phone, email, a link to my direct calendar. And that's also where people can download a complimentary copy of my digital book, The Busy Professional's Quick Guide to Investing in Multifamily, which was designed to educate and empower investors. I
love that. And is that what the DBA stands for?
Exactly. It's Dream, Believe, Achieve Capital Group, but it's very long to spell out, so I abbreviated it to DBA.
It sounds great.
Thank you.
No, that's a great name, and especially when people ask you what it stands for, when you tell them that, I'm sure it puts a smile on their face. So no, Vessi, other than that, we really appreciate your time, and again, I think our listeners are going to get tremendous value, and we're very happy to have jumped on this call and discuss everything further. Anything you want to add, Jon?
No, I'm good. I want to appreciate again for your time and being here and providing value to everyone. I'm sure it has been a lot of topics that we talked about, and everyone's going to get to learn a lot. So thank you very much.
Yes, thank you so much for having me on. I really enjoyed our conversation.
Thank you so much. And with that, guys, we wrap up our 4th episode, Invested Passively in US Multifamily Show. We hope you got tremendous value out of our special guest, and we'll see you on the next one. Cheers.